Good afternoon, everyone. Thank you so much for joining another webinar from Stock Specialist. We had a really good amount of positive feedback from last week and a couple of follow-up questions as well. So I'm pleased to announce that we've got our CEO, Mark, here joining me. How are you today, Mark?
Really well, thank you, Marco. Thank you so much for having me. And I'm really excited to be interacting with our investors here today.
Yeah, so Mark's going to run us through, again, a very sort of similar outlook. A lot of things, as the market is always quite fluid, a lot of things always happen quite quickly. So Mark's going to run us through, similar to what we spoke about last week, the macro fundamentals, and of course, our forecast and what we expect to happen going into 2023. So thank you, Mark.
Thanks, Marco. Thank you all very much. Okay, so very happy to be here. Just some general housekeeping here. So this is not personal advice, ladies and gentlemen. Have to remind you all that we aren't taking into consideration your personal circumstances. If you are seeking personal advice, please consult your financial planner or advisor. And also keep in mind that past performance isn't indicative of future performance. And now that that's out of the way, so for the agenda, which Marco touched on a little bit earlier, so we're talking about what we're doing and where the markets are today. We'll be looking at our 6-month forecast, some interesting themes that are playing from a macroeconomic perspective, which will be filtering down across the equity markets, both here and abroad, like the US market, European, and also the Asian market, which is going to be an exciting topic to touch on, and some food for thought, which I'll be able to put in front of you all today as a little bit of an early Christmas present. And then Marco will then be coming in to talk about De Grey Mining, a gold miner moving into production. We're looking at Yancoal, one of the country's largest coal based producers and 100% exporter there across the Asian region. And then we'll be looking at Beach Energy, somewhat of an undervalued kind of energy play there within the WTI space. So where's the market? The ASX 200, we're still somewhat bullish on, correcting about 6.5% there year to date, only down about that 3% since over the last 12-month period. It's still doing better than its US counterpart. We like the ASX 200 more than the US in the sense that at these levels, it's been supported by really strong commodities prices off the back of things like iron ore, off the back of base metals, nickel, tin, copper, aluminium, nickel, zinc, as well as also precious metals there. And we're seeing somewhat of a climb up there in the uranium prices, which we'll touch on a little bit later there. Marco perhaps can touch on that. The S&P 500, they were talking so much about that bear market, and a lot of pundits were, very much doom and gloom. But a lot of the investors that bought into that had unfortunately missed out on a lot of the returns. Moving forward, we also expect the returns to be there, perhaps not as strong as what they've been over the last 12 months, but certainly to back the Aussie market and the resilience of the economy is something that we're sharing with our members, and something that I'll be touching on. We'll also be talking a little bit there about sentiment. Sentiment's coming off there a bit there in the US, and we'll be commenting more on that in the Aussie market there to come. So market sentiment continues to be influenced by 3 major drivers. One's the resources sector, looking at pushing the ASX 200 further, right? And we've seen that off the back of iron ore prices, which I'll touch on shortly, natural gas, as well as WTI crude, so oil, and also the base metals. Central bank intervention is also being looked at, right? We've had that significant appreciation there, with the cash rate now sitting at about that 3.1%, right? And it's looking at driving a little bit further. But are they going to be as aggressive as what they've been over the last 8 months odd? The answer is no. They aren't going to be that aggressive. There's going to be some break periods there in between. China's also reopening, coming out of that COVID zero policy. A lot of market pundits have overlooked China. We are bullish on China with respect to our outlook moving forward. So what's it mean for an investor? When it comes to diversification, there are some opportunities to consider that we've been recommending to members. The ASX 200 there, again, supported by the resources sector. We like the ASX 200. We like those mining stocks. There are some small and mid-cap miners there with respect to the iron ore space that we have been touching on. Your BHPs, your Rio Tintos. Mount Gibson Iron MGX is one that you could also pop on the watch list there. And with the ASX 200 returning about 5% since the beginning of the calendar year, the resources sector nearly outperforming close to that 3 times, right? And so there's more to go, we believe, in the resources sector. Now, when it comes to contrarian plays, gold is something that we've been bullish on. Gold is something that we've been recommending, right? From about November last year, gold, right, when at its weakest levels, dipping to about that 1650 US an ounce. Now that we've got inflation softening with respect to its rate of growth, it's been easing in the US and here in Australia. We've then had the Fed and also the central bank here in Australia ease off of the interest rate acceleration pedal. This has seen the USD decline. Investors have realized that there's returns to be made in the equities markets, as well as also back here in Australia. And so we've got gold there sitting at about that 1779 US an ounce, and some good gold producers. One of them is De Grey Mining, which Marcos will touch on. Others that I want you all to consider, jot them down there if you have a pen and paper handy. Northern Star, NST, Newcrest Mining, Evolution Mining, EVN. Now, these are a few of the recommendations there which we're providing coverage on. High conviction buys. Northern Star, $10.70, for example, about that, with a target price in excess of that, which we can have a chat about there later on. Yep. And so market drivers there for gold, up about that 10% from their September lows. When it comes to rebalancing portfolios, you'll all consider your own personal circumstances. And I know some of you have kind of that love-hate relationship with gold. It's understandable. Looking at the macroeconomics, where we're going on a cyclical basis, we've got the USD softening. Gold is not to be overlooked. Pop it on the watch list, whether it's in the form of an ETF, whether it's in the form of a gold-based producer miner. For example, GDX, the VanEck Junior Gold Miners ETF. Pop it on the watch list. We're providing coverage on that, and it's something that you can pose questions to us later on, or something that you're able to give us a call about, and we'd be happy to have a conversation about. And iron ore prices there, with respect to market drivers, sitting at about that 109 US a metric ton. China's easing COVID restrictions. China's looking at quantitative easing plays, investing more into their economy on the open, being our largest trading partner. It's only obvious that we've got those large players here, like BHP, like Rio Tinto, like those mid-cap iron ore producers there, which we're providing coverage on. We expect demand to continue to climb for iron ore and to accelerate moving into 2023 and through to mid-23 as well. So when you're looking at market drivers, the Fed, they're scaling back the acceleration, the rate at which the interest rates have been climbing. There's been a lot of doom and gloom talk. Again, a lot of investors have been sitting in cash and are now starting to realize that there's still some pretty good return there to be made, in terms of having those cash reserves on the side, but also then looking at dividend paying stocks, some good yielding stocks, which we've got there in our income portfolio. The scaled back rates increasing by about 50 basis points, with the federal funds rate now sitting at about that 4.5%. They're looking at a terminal rate which will be likely higher than 4.6. But again, it's not about it's not so much when we'll get to those terminal rates. It's more about the rate at which the Fed is implementing the rate rises. And it's not going to be as aggressive as what we've seen over the last 7-8 months, as inflationary pressures have now started to ease more. And so they're back here at home in Australia. We've got the cash rate now sitting at about 3.1%, with a bit of a grace period there by the RBA, right? About 25 basis points. So we've got after 8 straight rate hikes, we've got servicing costs there, which we're all feeling with respect to our mortgages. And so what we've seen now is a lot of redraws and a lot of, a lot of paying down on mortgages. so as to be able to assist. Offset accounts are being drawn on, and so there's a lot of pain within that property space. More rate hikes, like the US like our US counterparts, are expected to come, but we are starting to see those inflationary pressures ease, and that's the key indicator, core inflation in particular, coming down. So when we're looking at China, we're progressing towards them reopening and preparing our reserves here within the commodity sector. We've got a price on iron ore there, bullish to say, so bullish at about 150 US a metric ton. With respect to exports, we're looking at that softened Aussie dollar, which is going to be a driver there. And the ATO would also be pretty happy in terms of taxation revenue. We're looking at about $58 billion to be skimmed off the top there. But with respect to the mining cycle boom, the super cycle that we've had, it's good to have a few of those key stocks there on the watch list, or even in some cases held by yourselves within your own portfolio, which you've seen returns on over the last 12 months, certainly. So where are the equity markets heading? We've got the S&P 500 there, kind of capped within that descending channel. Immediate near term, a little bit bearish, bearish tones. We've got strong support at about that 3,500 level there on the S&P, which is at about that 50% Fibonacci retracement level. And, we're not expecting that level to be broken down further south. There is still private sector in terms of corporate health on balance sheets. Yeah, they're being squeezed a bit there by rising rates, but they're well capitalized. Private sector is still well capitalized after having gone through about that 5, 6 year, 7 year period of low interest rates of a low interest rate environment relative to 1990, 91 back here in Australia. We're still doing pretty well, kind of on a relative basis. Capitulation in terms of market surrender is only now just starting to kind of come through the economy, right? Since we've been in that stagflationary context with rising inflation and kind of that shrinking GDP. But it may not materialize as quickly as what other pundits are pushing. We expect the 3,000 level to be retested if inflation continues to climb, but it may not be the main topic because the indicators are pointing to it softening, and therefore the rate of interest rate increases also easing. Coming back home here to Australia, we've got the ASX 200 doing better than the American counterpart. We're again, like the US, still a little bit of a risk there for a market downturn. Not those significant sell-offs like we had seen in 2020. That was a roller coaster ride, which was stomach churning to say the least. However, opened the door for excellent opportunity, and it's the same situation now. We are looking at those sectors like mining resources, like healthcare, like financials, with respect to those insurance players, for example, like consumer staples, which are like those industrials, which we'll touch on later on, which are able to produce those excellently yielding returns, as well as a great upside for growth there moving forward. If the key level of 6,400 there is tested and broken, we expect a potential move there to about that 6,000 level, right? Unlikely, but it's good to be aware of where we are and where the markets could potentially move. Marco, over to you.
Thank you for that, Mark. So I'm sure you've noticed, everyone, just there on the top right-hand side of your screen, Mark's obviously touched on quite a few things when it comes to the macro context, but we have particular exclusive membership deals, as you can see there on the screen. You can have a quick look, click the link in the description there, and you can find the landing page there. But I want to talk about stocks. That's my job. So I'm going to focus on a few things here. As Mark said, there are always undervalued plays in the market. There are hundreds of plays, regardless of how the macroeconomic context is laid out. But I'm only going to touch on 3 for today. As Mark said, a gold miner, a coal miner, and a oil producer. So the first one I'm looking at is De Grey Mining, DEG. I do believe I mentioned this one last week. And this in terms of the potential upside, we've seen where we previously put high conviction recommendations on companies like Northern Star when they really hit that sort of $8.50 mark. Which is quite ridiculous considering it's the second biggest gold miner in Australia. Now it's sort of come back up to that $11 mark, which is great considering all this sort of shock horror that a lot of investors have had to put up with this year. But De Grey is, in our opinion, the one with the most potential upside. The primary reason for that is their flagship project is the Molina project there in Western Australia, very close to a lot of high yielding, high bearing pegmatites over there, quite near a lot of the lithium plays as well in the area. But of course, focusing on the gold, they recently did a capital placement, which was an oversubscribed capital placement. They raised 130 million before costs, but probably not a lot of cost involved there for a relatively small raise, but that essentially means that they are now fully funded all the way up until their final investment decision for that Molina project, which is looking to produce about 550,000 ounces per year at current stage 1 processing for about 10 years. And on top of that, I do believe from memory, their all-in sustaining cost is somewhere in the region of about 1150 to 1250 Australian per ounce, which is fantastic, especially when you compare them to a lot of other companies, even companies like Evolution, which have seen their margins sort of squeezed recently, or companies like Red 5, which have about a $2,000 per ounce cost. So taking a look at that, our target price, I do believe, is currently sitting about that $1.50 mark in the short to medium term for De Grey. That's already given our customers about 30% return in the last 3 months. Not too bad for a gold stock. And we have, as I said, bit of still potential upside ready to go. But another great one is Yancoal Mining, Yancoal Australia, I should say. Yancoal Australia is one of the biggest thermal exporting companies in Australia, only second, I believe, to in total coal production, only second to Whitehaven. But the thermal coal production, which is the essentially brown coal or energy producing coal, is their primary source of income. And that's seen Yancoal with a massive increase in the coal price this year, which I'll touch on the next slide. But with the massive increase of revenue they've been generating, they had somewhere in the region of about $4 billion in debt this year. And now they've reduced that to, I think, only a few $100 million in the course of a year, which is pretty fantastic. And so they've risen about 120% this year. And we've been covering the stock for quite a while, but we actually recommended it as a new high conviction buy about 4 weeks ago, and has already done about 43%. Considering in the last 2 weeks the market has gone down, we're pretty happy with that. And you can see there, if you're taking a look at the technicals, obviously the 50-day, it is a little bit difficult to say. We'll take a look at that one, but that red line is essentially that exponential moving average. You don't really want that going above your trend line, so that's good. We're seeing a lot of positive support there, about that $6 to $6.50 range. We're expecting that to head back into the all-time high region of about $7.70 to about $8.70 in the coming 6 months. And just further to that, so as you can see, pretty great chart for anyone who was invested a couple of years ago. As you would expect, not a lot of traction going on for coal during the COVID years, with your energy basically being shut off. But you're getting about 145% increase since the Russia-Ukraine crisis in February. And as I mentioned, the interesting part about this, and one of the many reasons why we picked Yancoal in particular, the metallurgical coal, which is the higher grade of coal, which is used primarily for steel production, that previously used to generate quite a large higher margin than a lot of other miners, which would be Yancoal, that produced that thermal brown coal, which is used for energy production. But now the massive increase for energy demand has actually reduced those margins. So now you're getting companies like Yancoal actually generating more revenue and more profit than their counterparts. So, and you know how I mentioned on the previous slide that they've reduced their debt to almost nothing. They also have in their most recent quarterly report a $3.5 billion cash balance as well, which has contributed to about a forecasted 20% dividend yield for the year. So it is not franked currently. I do believe they will be starting to pay income tax early next year, which will contribute to the franking credits, but still 20% yield is nothing to laugh at all. So just on our final one, I do really like that slide there. So Beach Energy. Beach Energy is a rather underlooked oil and gas producer there in South Australia. On the next slide, you'll take a look. There has been, you'll notice the main thing about this chart here. Look at the Bollinger Bands. There's a lot of volatility, but it's pretty much trading within a very tight channel. And the only one point that I wanted to make was about the RSI, which is basically just a stochastic indicator. That's indicating a slightly oversold reaction. The primary reason for this was quite recently, it was a few weeks ago, I shouldn't have really put failed takeover, but it was an attempted takeover of a company called Warrego Energy. This was, I guess, outbidden by Gina Rinehart's Reinhart Prospecting, which, if you had to go up against them, that's, pretty difficult. But they obviously had a very strong assessment of Warrego Energy at the time. But I think it's quite prudent for them to actually maintain the cash that they had on hand instead of trying to outbid, people like Gina Rinehart. So on the positive side as well, they currently have over $1.2 billion in free cash flow, in free cash, that the company is looking to further deploy for merger and acquisition opportunities going into next year, which I think would be really great. A lot of these newer exploratory oil and gas companies, and this is how they build up their asset base. So I'm really looking forward to Beach Energy next year. And yeah, so you can take a look there. The oil price has sort of seen a little bit of a downturn in the last sort of 3 months. The oil futures in particular, due primarily to a lot of the volatility and what's actually happening. It's been, as you can see there, quite volatile since February. But a lot of these companies, they have to forecast supplies for the global economy. So on the positive side, you have things like the US Biden administration planning to buy 3 million barrels of crude. I do believe that's per day, not per month. But yeah, they're looking to really stock up their US strategic reserve, which is really good. But despite the recent pullback, we are quite bullish in the long term for the oil price. And just as a comparison, from a market capitalization perspective, Beach Energy currently has a market cap of about 3 billion. Woodside Energy, on the other hand, has about a market cap of about 45 from memory. And the most recent quarterly report from Beach Energy, they had about 6 billion barrels per day produced at very strong margins that are comparable to Woodside. So essentially, when you look at the potential upside compared to I should restart. The potential upside for Beach Energy compared to, say, Woodside, there's a possibility if they utilize the free cash that they have on hand effectively and really build up that oil and gas asset base. Who knows? That could be a possible 5-10 bagger in about 10 years, which would be really good. I'm looking forward to that one as well. So yeah, thank you everyone for joining here. I'll pass back to Mark, and thank you so much.
So, ladies and gentlemen, investors there, we've got the box on the right-hand side there is flashing. Yep, top right there, just flashing. Just have a click on that. And so, look, we've got now on the Christmas period there on our Diamond membership top tier package. We've got some excellent specials there happening as a Christmas present there for you, exclusively having entered and joined in on this particular webinar. Off the back of the performances of our research portfolios, you're getting exclusive buy, hold, and sell recommendations across our growth, income, and mining portfolios. What you're getting is also those contrarian plays, knowing which sectors to be able to move into, how to potentially rebalance the portfolio there for the better, moving forward, as you know, particularly as we've had a lot of pundits out there in the market talking about, you know, weakness that we've seen, you know, that drama, which essentially didn't happen. A lot of investors unfortunately missed out. Moving forward, we've been talking about gold, we've been talking about coal, we've been talking about those base metal producers, we've been talking about insurance players, for example, like Medibank Private, MPL, $2.70 to now that close to $3, 5% odd dividend, fully franked. Excellent income players moving forward, heavily sold off on the technicals, as well as also the industrials, as well as also the consumer staples. So these are some of the themes that you know that we've been talking about. Contrarian players out there abroad, like China. What are they going to be looking like over the next 3 years? International diversification, some excellent themes there on the diamond. So you can see there the platinum, which is substandard to the diamond, usually at about that 2K. We're doing it on a Christmas special for 1497. The diamond package, our top tiered service, you're getting usually it's at $6,000. We've cut the price, $3,000, 2,997 per annum. You're getting the daily, you're getting the growth, the income, the mining, the ETF portfolio. You're getting a defensive portfolio. You're getting a software where you can filter through all 2,500 stocks that are on the market. You're able to then be able to say, hey, I want to know which income stocks are paying more than 6%, 100% fully franked. It's filtered there. And then what you do, you give us a call. You have personal account management. You have the ability to be able to work with us. Send in a copy of your portfolio there for commentary, you know, to be able to say what's going on, what could I be looking at doing moving forward into the new year, and we'll be able to definitely assist you there. And you aren't paying statement of advice fees, wealth management fees, brokerage fees, or any of that. It's all included as part of the membership there, obviously under those general advice terms. Best value for money there, we're doing 3-year diamond membership at 4497. Best value for money. You're looking at extensive terms, 3 years. I'm basically giving it to you there, throwing it away because I want you to come on board. I want to work with you personally. So exclusive webinar offering there that we're giving you today for making the time, watching and joining myself and joining Marco. And if any questions there are coming through, I can see here a couple of questions there are coming through. We'll be able to give you a call now that we've got your details. We'll be able to give you a call back. We'll be able to certainly reach out there to you straight after the webinar. And I look forward to chatting there with you. Thank you all so much for coming in. I look forward to doing more of these and interacting more with you. I want you all to have a Merry Christmas and a safe holiday period. And we'll chat to you soon.
Thank you so much. Thanks everyone for your time. Really appreciate it.
Thank you.